Welcome to another episode. Today we are going to discuss how depreciation affects you and affects your bottom line. So first off, the number one misconception with depreciation is that many people think it's dollar for dollar. If I get you $100,000 worth of depreciation, many believe that saves them $100,000, and that is not true. Depreciation is a loss. It's an expense. So just like if you had a business, you made $100,000, and then you spent $100,000 on the business, you won't have to pay any taxes on that income because it's offset by the losses and by that expense. So too, by depreciation, you're just saving on the taxes of $100,000, and the taxes of $100,000 could be 20%, 25%, depending on what tax bracket you're in. Let's just, go generic with 30%. That means you will be saving $30,000 cash off of $100,000. If I gave you $100,000 worth of depreciation, you are saving $30,000 cash. Not $100,000 cash, but $30,000 cash, right? So that is numero uno. Number two, there are two buckets for depreciation. There's passive depreciation and then there's active depreciation, right? If you are running your own business, any money that you make from that business is going to be tagged as active ordinary income, and any expenses you have in that business is going to be tagged as an active expense, an active loss, and it will offset the active loss, will offset the active income, right? But let's say you're running your business and you have a passive investment. Those will not offset each other. If you have a passive investment and it is producing for you a loss, an expense, you're pouring money into the business to help the operator grow it, but you are not actively involved in that business, its expenses will not offset the income you're making from your regular business. If you have a bowling alley, you're making a lot of money from your bowling alley, you're investing in a pizza shop, the pizza shop's losses will not affect yours. With real estate, most people are barred from making it an active loss, and this is with intent, right? But if you are a real estate professional, it will turn all of your real estate losses into active. So if you're investing in real estate on the side, and you have your regular business, you're a dentist, you're a bowling alley operator, I don't know, you're a financial advisor, you're making $300,000, $400,000 a year, and your depreciation from your real estate is $100,000, $200,000, it's not going to offset your income because the depreciation is a passive loss and your business is an active income. In order for the depreciation to offset the income, it has to match. Either it has to be passive income and passive losses, or active income and active losses. If you are a real estate professional, and we will get into what that is exactly in a later episode, you will be able to turn all of your losses into active losses, and it will work not just for your income, but it will also work to offset your spouse's income, right? So if your spouse is making $500,000, the losses from your real estate, if you're a real estate professional, will be able to offset your spouse's income. But if you are not a real estate professional and you and your spouse are making a lot of money and you have real estate as investments, that depreciation will not help you. All right? So number one, depreciation is 30 cents on the dollar. And number two, make sure to match up your losses with your income. If your income is active, you're going to need active losses to offset that. And if your income is passive, if you have a lot of passive income coming from rental real estate or businesses that you're not actively involved in, then the real estate losses, which are passive losses, will offset the income. All right. Have an awesome day. Hope this was useful. Next episode coming out next week. Stay tuned.